Well, good day, traders. Chris Weston here, Head of Research at Pepperstone. And this week we're talking all things volatility. This is the volatility sessions. We are looking at the different volatility measures. It's come up, it's risen. It's been very strong this week. It's hit us in the face like a wet kipper. And we are now looking at very, very elevated levels of implied volatility, certainly in equity markets, certainly in fixed income. Even our little friend FX markets have seen a little bit of a pickup in implied volatility. There is a pulse finally in the FX market. And in fact, we've seen an unwind of that carry trade coming through. So we're going to be talking all those volatility metrics, what the market's implying of moves and how we should position our portfolio, because there has been some fantastic opportunities playing through in various markets as well. Certainly from the short side in equities. Is that elastic band being pulled back a little bit too far? My internal models and equities are suggesting there is extreme pessimism now being priced into the stock market, but rightly so. People are looking at the coronavirus. It's not about China anymore. This is about the spread going into 45 countries and how much further can this be? What can be the damage to economics, and will central banks largely be able to support in that mechanism? So let's go and look at FX markets, see how they've done over the last 5 days. It's not going to surprise. We've got the Japanese yen up 1.9% against the US dollar. The Japanese yen has been our friend, the safe haven. There had been concerns over time that perhaps the Japanese yen had lost those safe haven qualities. Well, clearly not anymore. Our good friend, the euro, up 1.43% against the US dollar. A little bit of better data coming from Europe, but mostly that's been an unwind of the carry trade. The euro's been beaten up pretty heavily because people have used that as your preeminent funder. Carry's been unwound. Obviously, that higher vol dictates income strategies, and therefore income's been unwound because of that higher volatility. The Swissy doing quite nicely, as you'd imagine, in that situation as well. Look at the bottom of the pile. You've got your high beta currencies on the EM side. The Mexican peso, which was doing so well when implied volatility was very low. People wanted to get paid to be in those positions. Mexico runs some very high real yields, and 3.7% real yields. You know, you're going to be very attracted when the equity market's going up and implied volatility is low. That's obviously not the case anymore, so people are dumping carry. You've got the SAFA doing poorly, and you've got the Brazilian real. Aussie and CAD doing very, very poorly there. We've seen oil prices under pressure as well. And if you look at the daily chart at the moment at dollar CAD, it looks actually quite nice. It's something that we're going to be looking as we go into the Bank of Canada meeting next week. But have a look at that dollar CAD chart. You know, we're breaking through those September 2019 highs. We're coming back at this point in time, just as I'm looking at this now, looking for that retest of the breakout. If this kicks on, you know, that dollar CAD goes higher, in my opinion. That's going to be one of the trades that we're going to be looking at for the week. Have a look at the implied measures in different asset classes here. I talked about those higher implied vols. You can see the top pane, the VIX. Now, we've just released this to clients. We trade this off the prices off the VIX futures. You can see the VIX cash price here, which of course you can't actually get exposure to. You can't actually trade. It's a valuation of various expiries in the VIX, which wait effectively to a 30-day rolling expiry. But you can see this now, the VIX index, and I've taken this over a 5-year view. I mean, people say to me, Chris, take this out to the GFC and you get a much more realistic picture of some of those extremities in the VIX. But I've taken a 5-year average. I've got the my standard deviation range bands there. So the blue line across the middle is the 5-year average. We're trading well above 2 standard deviations now. We're probably trading close towards 4 standard deviations of that 5-year average. We are at levels now where markets have been quite keen to fade implied volatility spikes. I really like that move back that we saw in December 2018 as a case study. You know, this is the point where we saw the Fed pivot, and we're actually seeing a rerun of this. We'll talk about the rates pricing, because that is just such an interesting story now. Back in 2018, December, we saw the market say to the Fed, we want to see an end to the QT program. We want to see you cut rates. The market went after the Fed. We saw the Fed do that big pivot. We are now at that level now where implied volatility is at similar levels. The middle pane is the implied volatility. We've aggregated that using the JP Morgan Global FX Index. And you can see after trading down to multi-year lows, people saying that implied volatility in FX markets was structurally flawed. We've actually seen that picking up a little bit now, so a bit of a pulse playing through there. Most of that obviously playing through in the high beta currencies and the yen, but we are seeing implied volatility in FX markets move up. It's still on a relative low levels when you look at the bottom pane, and you can see the Bank of America Move Index, and that looks at implied volatility on a weighted basis across 2s, 5s and 10s US Treasuries, and you can see that pushing right up to the highest levels it's been for a long, long time. So implied volatility in fixed income's been something that's been working well. And of course, in my opinion, you stay long treasuries. We're looking for the 10-year to trade down to about 1.23%. So it's a little bit lower than where we are at the moment. as long as the central banks, such as the Fed, are not actually coming out and giving us a really clear picture that they don't want to cut rates in the near term, then I think you buy treasuries. I think that yield curve continues to flatten. But you can see there the different volatilities have been moving up. Now, one interesting chart which we've seen, of course, has been that massive move that we've seen in equity markets over the last 5 days. Of course, equity markets done very well over the last few years. Liquidity and buybacks and various factors, a very supportive central bank structure and very low implied volatility has kept that market making ever greater higher highs. The concentration risk has been very strong. You've seen Brett very, very poor. Such a concentrated group of stocks has made that gains and those higher highs. And we've seen a collapse coming through. As you can see from the top pane, there is no such thing as support when you've got these markets moving like this. We've traded through the 200-day moving average. We traded through that trend support. It hasn't even touched the sides. It's just gone straight through. But look at the bottom pane. You can see here, this is the Bloomberg Financial Conditions Index, and this looks at various facets like volatility, the S&P, it looks at money market rates, it looks at other factors as well. But the Fed look at this very, very closely. We know they look at this one closely, and you can see that they look at inflation expectations and broad financial conditions. Maybe they don't look at the Bloomberg one, maybe they look at the Goldman Sachs, maybe they've got their own proprietary model, but we know they look at financial conditions and the impact that this has in the real economy. You go back to 2018, when they looked at financial conditions, they said, this is too much, we're going to have to change. We're not quite at those same levels as 2018, but we have seen this rapid collapse of financial conditions. And I don't think it's a surprise then you're going to see on the rates chart just exactly what's being priced in as a result of that collapse and that tightening of financial conditions. This is such a fascinating chart for me now. Have a look at what's being priced in. The Bank of Canada. We've got a central bank meeting now on the 4th of March. The market's pricing that at a 40% chance. Go out to the next one, which is the 15th of April. There's a 57% chance of the Bank of Canada cut rates. So there's a Bank of Canada meeting next week. We are going to be expecting some sort of signs that they're going to give us a pretty clear signs of easing. The market's saying there's a 40% chance, so it's almost a live event. If they don't cut, you could see some volatility around dollar CAD. We'll talk about the implied volatilities in a minute in dollar CAD, but the market is saying if they don't cut there, well, there's probably a slightly greater chance they will do it at the next meeting in April. Go out to the swaps curve over 12 months. We've got over 3 rate cuts being priced in Canada over that time. In England, in the Bank of England, we've got a 30% chance of a cut in late March. Go out to the 7th of May, well, it's pretty much a done deal. 84% chance they don't cut at this meeting, which is unlikely. They're going to give a pretty good indication that they cut in May. Go out to the Fed. Of course, we're looking at the Fed. Now, this is interesting. The Fed at the moment have said that they need to see a material change in the backdrop for them to adjust policy again. But they're open to it, but they need to see a material adjustment. The markets are saying we're seeing that material adjustment at the moment. We're seeing it from this tightening financial conditions. We're seeing this from this supply disruption issue. The market's saying we've got an 85% chance that the Federal Reserve cut in March. Now that seems to be, to me, a little bit high. I think at the most they're going to open the door to a rate cut in April, which the market's now saying that there's not just a full rate cut being priced in, but there's a 43% chance that we get a second rate cut being priced in on the 22nd of April. There's clearly a rates trade being placed now. I'll be paying rates, trading rates from the short side there. But for me, what's being priced into the dollar, and we look at dollar yen, you can see an 85% chance they're going to be cutting rates. I just think that's a little bit too high. Look at the data next week in the US. That will probably cement those rate expectations or bring them down. We've got the ISM manufacturing numbers on the 3rd. They're expected to be slightly weaker. The market's expecting that to go from 50.9 down to 50.5. Wouldn't be surprised if we saw that down towards 50. But if we got a strong number, now, economists like Morgan Stanley are expecting that to be above 54 on that diffusion index. Have a look at the ISM services number that comes out later in the week. Again, that's supposed to be pretty good. We got then the non-farm payrolls number on Friday, where the market's looking for 195,000 jobs. Does it really matter when we're really concerned about what the future looks like under the coronavirus and the impact that's going to have on a global basis? We're trying to model something that's very, very difficult to model, and when we don't get those answers, we go into risk aversion mode. So do the non-farm payrolls matter? Perhaps to some people, but I think to the broader market, less so this time round, because the big macro thematic is coronavirus. We do have the RBA meeting coming up next week. Again, we're not expecting fireworks from that meeting, but they will need to open the door, because if you have a look at what's being priced in through the curve 46 basis points over 12 months. The market's expecting nearly 2 rate cuts. They've got a 62% chance of a cut in April. So the RBA will need to open the door to a rate cut in the April meeting if they don't cut at this meeting, or we will see some disappointment. The Aussie dollar should rally. We should see a bit of a sell-off coming through in the front end of the bond market on the back of that as well. So do keep an eye on that. We get GDP numbers. I'm not so sure, again, the market's going to be too concerned about that. And then retail sales towards the back end of the day. Does domestic data matter for the Australian dollar at the moment when it's still being used as a proxy for this EM trade, this global slowdown that people are obviously pricing in? Copper's traded fairly well recently. The CRB commodities index has held up fairly well. And I think that's somewhat supportive, but I think the Australian dollar is still being used as this kind of global slowdown trade that people are trying to model and failing miserably. Aussie dollar's had a terrible week because of that phenomenon. Josh Frydenberg obviously saying to the public that we're going to get more impacted by this than anyone else. Have a look at the data flow. We've got China, I think, again, is very interesting. We've got the PMI numbers coming out this weekend. We could see some gapping risk on Monday if they're really, really poor. It's just going to hit us when the wind's to our backs in terms of that risk aversion. So do have a look at that. We also get trade data. We're going to be looking at those import numbers for February. Are they going to be showing just a huge amount of weakness playing through in terms of demand? Go back to that volatility. Now let's have a look at implied vols. I've got 1 week implied volatility. Aussie yen, 11.7 here, if we go to that middle pane. We've got the realised volatility, which you guys will probably be using things like ATR to understand the distance to your stop. We want to leave our stop loss 1.5 times ATR, all that classic stuff. But I like to use the implied vols. Aussie yen, 11.7. That's getting into the 70th percentile. We've got some life back into this old dog, 70 percentile. The market's therefore saying Aussie yen could go up or down 100 points with a level of confidence of 68.2, because that's one standard deviation. So the range on the week, based on all the information that we know and all the various factors that we're looking at, 72.80 down to 70.82. Use that as your guide. Going to dollar yen, which of course has been faded from 112. We're pushing up to sort of 112.20. The market's done an about turn. There was this kind of separation between yields. Yields were going down. And for a large period of time, we had seen dollar yen going up. People saying that doesn't make any sense. That's not what we usually see. Now we've seen that mean reversion coming through. That risk aversion has seen that yen really working well. That dollar yen has caught back up with the fall that we've seen in yields. But we've seen dollar yen vols move up into the 72nd percentile. The market's there looking for a 108-point move. So dollar yen's expected to trade 110.45, 108.29 on the week. Euro dollar, we've seen some vol action here. So we've got a 6.6 implied vol there. We'll touch a bit on the Aussie in a minute, but the implied move in Aussie yen, so euro dollar, 110.88 down to 109.20. Go into the aggregation of the index vols that you can see here from the CBOE, and you can see that the VIX obviously trading at the 100 percentile there. Global market FX vol there, we talked about up to the 51st percentile. Have a look at skew. I think this is really interesting for semantics as we go into this week. Aussie dollar risk reversal. So what we're looking at is 25 delta 1 week call volatility minus 1 week put volatility. So what we're seeing with Aussie dollar is that's trading at negative 1.01. So put volatility, effectively the right to buy downside, is trading at a decent premium now to call volatility. That, when we put that into context of the 12-month percentile rank, that's trading down at the 25th percentile. You can see the high-low range there. It's been down as low as 1.3 vols differential there. So what we're seeing is people paying up for put volatility relative to call volatility. It tells us that the options market is obviously betting on better downside. So we want to continue to stay long, sell rallies in Aussie dollar, in my opinion. Have a look at dollar yen, because that had been pushing up. People have been getting towards that parity mark. The skew of volatility here in terms of that volatility difference, negative 1.5 there. So put volatility still trading at a decent premium to call volatility, and that's come back down to the 35th percentile. Gold risk reversals. Now we're seeing calls trade at a 3 volatility premium to puts. That's 75th percentile. Now that was trading up to about 3.5 earlier in the week. So I was saying to clients in my weekly gold report that was probably getting a little bit too extenuated there. Have a look at this chart here now of Aussie dollar 1 week volatility relative to 1 year volatility. So what we're doing is we're looking for the outperformance, or that percentage differential between short-term volatility and longer-term volatility. When short-term implied volatility is pushing up, that demand for short-term options is moving aggressively. People are obviously seeing really clear near-term movement in the Australian dollar. That's obviously been pushing up to right up to that top end of the range. So people are betting or starting to bet that we're going to see much greater moves in the short term. Again, we're looking at that risk reversal on the bottom one, which we're looking at 1 month Australian dollar risk reversal, so that skew of call volatility to puts, and you can see that's trading down to sort of lowest level since May 2019. So again, something we're looking at very closely in there. And the daily chart of Aussie yen looking pretty weak at the moment. So we've talked about everything that's going on in the markets this week. Yeah, we will need to see these central banks, whether it's the Reserve Bank, whether it's going to be Fed speakers who will be coming out, whether it's the Bank of Canada, whether it's going to be speakers coming from the ECB, whatever it's going to be. We now need to see, the market needs to see reassurance that they're on the right track. They've made their mind up that we're going to see a central bank response, whether rightly or wrongly, that it's actually going to do anything. And now we need to see the central bankers come on board. If the central bankers don't come on board with their vision, they're going to throw a bit of a tantrum, and I think volatility is going to stay high. So stay safe in these markets, understand the risk that's going on, which we talked about here, and adjust your stop losses accordingly. So good luck to everyone out there today.